Hey everyone, welcome back to our usual chat that we have about the portfolio strategies that have recently shown the best performance. I'm one of the coaches from Unger Academy, and today we're going to be looking together at two strategies on gold futures that are performing really well. Now just think, in the last 24 months alone, they have collectively made more than $37,000 on a single contract. So let's go and take a look at them together now. But before we start, as always, please leave us a like, subscribe to our channel, and click on that notification bell to stay updated on all our new content and our new videos. Thank you. Okay, let's start by looking at the metrics of the first strategy. We find that this strategy doesn't trade very much. It's made 600 trades over 15 years, so about 40 per year. In doing so, generated a net profit of $67,000 and an average trade of $110. Looking at the annual rolling, we can see that in recent years, for example, starting in 2021, the average trade has increased significantly. I mean, $260 per trade is definitely a remarkable value for the instrument that we are discussing here. Looking at the monthly rolling, we can also see how this strategy has made a profit of $22,000 on a single contract over the last 2 years, and that would be from April 2021 to April 2023. So the question is, what strategy are we talking about? Well, we're talking about an intraday strategy on gold with a 5-minute time frame and data from 2008. Now below, we see that it also uses a secondary series with a 15-minute time frame. And this strategy first waits for a price movement in a particular direction, such as down, and then enters in the opposite direction, such as up, when the market has signaled a recovery. We enter long when the recent lows are broken, or short when the price falls below the recent highs the market reaches. The system is symmetrical, and that means we have a mirror image condition for long and short positions. And because it's a commodity, this is a best practice that we use at Unger Academy to add robustness to our strategies. The positions are then closed at the end of the session, or with the standard monetary exits with stop loss, take profit, and break even if they occur before the end of the trading day. All right, so let's go and have a quick look at the chart, and let's see how this strategy works. Here we see a session where a short trade was generated and closed at a profit. This is the minimum that was reached in this session. Then in the next session, after falling below the low, there was a price movement and an upswing in the market prices. And this is where we entered to close our trade with an excellent profit. All right, let's move on to the second strategy. Again, we work with the gold future with a 5-minute time frame and using data from 2008. All right, so let's just go straight to the metrics. Here we have a net profit of $202,000 and a number of 1,200 trades, which gives an average trade of $162, which again is excellent for the instrument that we're trading. Oh, the equity curve is truly enviable. An interesting fact is that this strategy was developed at about this point, which I'm indicating to you now, and it was launched in 2016 and continues to perform as if we were still in the development phase. And it's very rare to find strategies that, when they go live, continue to perform as well as they did in the in-sample period. Well, we find that the curve is very nice on both the long and the short sides. Even for this strategy, the gain over the last 2 years from April 2021 to today is substantial. When combined with the previous strategies, $15,000 with a single contract gives us the $37,000 that I mentioned earlier. But now, how does this strategy work? Well, the logic is very simple. If the last day closed not far from the previous one, as we can see in this session, so if we come from a relatively flat session, we could say, then we'll either go long if yesterday's high is broken, or go short if prices fall below yesterday's low. So this is a trend following strategy, meaning it tends to follow the direction that the market is going. We're working on a commodity, and as we have already seen before, we need to adopt a symmetrical trend to make our strategy more robust. And this also closes the positions at the end of the session, which also reduces the risk associated with having open positions for several days. It follows that the duration of the trades will only be for a couple of hours. Similar to the previous strategy, we have monetary exits in the form of stop loss, take profit, and break even that are triggered if these values are reached before the end of the day. So let's take a quick look at how this works here in the chart. This is the previous session. As we said, this has to be pretty close for you to have a chance to enter the market. This is the high of the previous session, and in the session that I'm showing you now, there was a break of that level to the upside. So we entered the position with a long order and then closed it at the end of the session with an excellent profit. All right. So today I showed you two strategies on gold futures that exploit a very simple logic. Nothing complicated, in short. And we should remember that simplicity in trading, understood as a limited number of conditions, always pays off. And the results of these two strategies are a good example of that. Now, if you'd like to learn more about how to develop such trading strategies and start your trading journey as a systematic trader, please go and click the link below. From there, you'll be able to watch a free presentation by Andrea Unger or go and get our best-selling book, The Unger Method, covering only the shipping costs, or even book a free call with a member of our team. And if you liked this video, please leave us a like, subscribe to our channel, and click on the notification bell to stay updated. Oh, thank you so much for watching, and we'll see you soon next time. Bye-bye.